No one has discovered any investment strategy which can be used with such confidence of success, regardless of what happens to the stock market, as dollar cost averaging. So spoke Lucile Tomlinson in 1954, having just conducted a 25-year-long examination of the stock market. In the 76 years since, there is still no method that is so simple for any investor to follow. Dollar cost averaging can make anyone rich if they are willing to put away a little of their income each month and invest it into the stock market. Having looked last time at how to choose an investing platform, we will now discover why small regular payments into this account is the way to go. To learn more about investing, make sure you subscribe and ring that notification bell. I'll be posting weekly to give you all the investment tips I can. Like the video too, it's great motivation for me to see people enjoying this content. Dollar cost averaging is simply the process wherein each month, or any time period convenient to the investor, he or she buys shares in the market, regardless of the current price. Whether the market is a bull charging up or a bear swiping down, shares are purchased regularly. This results in the investor obtaining shares at a price that is the cost average of his purchases over the time period. The investor pays a fair price for his or her shares, as they have been bought through both high and low periods. As always, I'm not a financial advisor. I simply make these for educational purposes to try and share some knowledge that I've obtained from years of reading books on personal finance. Any investment risk you take is yours and yours alone. With that being said though, what do some better investors than myself say about dollar cost averaging? When Warren Buffett was pressed for his best advice to any investor, he said, and I won't attempt the Omaha accent, consistently buy an S&P 500 low-cost index fund. I think it's the thing that makes the most sense practically all of the time. Keep buying it through thick and thin, and especially through thin. Jack Bogle, the legendary founder of Vanguard, adds that dollar cost averaging is the way to go for 95% of investors. And here's why. Let's say you set up an investment account, like we discussed in my last video, the year before the 2008 recession, and decide to use dollar cost averaging to buy $100 worth of shares in the S&P 500 every 3 months. Remember that the S&P 500 is just a fancy name for the market index that represents the largest 500 public companies in America. So our first purchase sees shares trading at $14.54 a share, meaning if we use our $100, we can afford 6 shares for our portfolio. 3 months later, we purchase again, this time at a slightly higher price of $14.63, so we're still able to afford 6 shares with our $100. Another 3 months later, the market has dropped down to $13.54 a share, meaning we can now afford 7 of them, so we buy again. Little do we know, but we are about to enter one of the worst market crashes in history. Should we as long-term investors be concerned? No. By the depth of the recession, our original shares have halved in value. But we are now able to buy these same shares for just $8.05. So our $100 now buys us 12 shares, much more than before. We continue this way, and it takes the market 6 years from our start point, just here, to recover to where it was before the recession. Had we invested all our money in one lump sum at the start, we'd have made a return of 0% over these 6 years and endured some large losses in the time between. But, as it turns out with dollar cost averaging, our regular small monthly amounts meant we were able to buy shares at their average cost over the period, as we bought some shares at a high price at the start, some at a very low price in the dip, and we've ended up outlaying a total of $2,357 in this period. But what is our portfolio now worth? $3,573. That's a 27% return over these 6 years, which may not sound that impressive, but bear in mind that this is a 27% return on our investments, despite having started investing a year before one of the worst financial crashes in history. This crash wiped out many investors, yet like Andy Dufresne, we've come out clean the other side. And crucially, what this also achieves is we are laying the foundation for a large portfolio of shares which are now ready to grow during the next bull market. When the good times come back, and we know that they always have done throughout history in the stock market, all of these shares we've been purchasing are set to rapidly increase in value. Have a look at the next few years of the market and think what that would have done for your shares having purchased them at these low prices. I'll finish with the words of Warren Buffett's mentor, Benjamin Graham, who is arguably the greatest investor in history. In 1960, he described dollar cost averaging as a policy that will pay off regardless of when it is begun, provided that it is adhered to conscientiously and courageously under all intervening conditions. In layman's terms, if we have the ability to regularly pay into our account, regardless of if times are good or bad, we give ourselves the very best chance of success in the long run, provided we are investing into the market as a whole as opposed to an individual company, where the risk is far greater. If you enjoyed the video, subscribe to Summitnomics and ring that bell. Drop a like and comment your thoughts on dollar cost averaging down below. I'll see you next time. Stay safe, and as always, happy investing.